You are welcome to session 6, the last session for Unit 2, Accounting for Financial Instrument. And in this session, we'll be looking at IFRS 7, Financial Instrument Disclosures. IFRS 7, Financial Instrument Disclosures. At the end of this session, you should be able to outline the disclosures required for financial instrument. Outline the disclosures required for financial instrument. Now, financial instrument disclosures. The objective of this IFRS is to require entities to provide disclosures in their financial statement that enable users to evaluate A, the significance of financial instrument for the entity's financial position and performance, and B, the nature and extent of risks arising from financial instrument to which the entity is exposed during the period and at the end of the reporting period, and how the entity manages those risks. Now we have categories of financial assets and financial liabilities. When we take the disclosure requirement for financial position, when you go to the statements of financial position, the things we see there are assets, liabilities, and equity. And all these are explained, or these are the elements that form financial instrument. The contract, remember, is a contract. A financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. And these are all presented in the statement of financial position. So when it comes to the statement of financial position, what is required of you to disclose? Now we have categories of financial assets and financial liabilities. So we have to disclose that. Then we have financial assets or financial liabilities at fair value through profit or loss. So you have to disclose the financial assets or financial liabilities that are measured at fair value through profit or loss. You have to disclose any reclassification that has been done. It must also be disclosed. Now you have to also disclose if there is any offsetting of financial assets and financial liabilities. So if you have offset financial assets and financial liabilities, you must also disclose this as an entity. You must also disclose if there is any collateral given in acquiring any of these financial instruments. They have to also disclose allowance account for credit losses. Allowance account for credit losses. So if there is any loss that you've incurred as a result of the financial instruments, if there is any account you prepared with regards to that, you have to also disclose that. And then you have to also disclose any compound financial instrument with multiple embedded derivatives. Compound financial instrument with multiple embedded derivatives. So we said derivatives are basically financial instruments that derive their value from an underlying instrument. Then you also have to disclose if there is default and breaches in the contract. You have to make these disclosures as well. Now when it comes to the statement of comprehensive income, what are the things you have to disclose? You have to disclose any net gains or net losses on each category of the financial instrument. Disclose the net amount if it is a net gain or net loss on each category of the financial instrument. You disclose that. You have to also disclose the total interest revenue and total interest cost or expenses. So you look at the total interest revenue and the total interest expenses. That must also be disclosed in the comprehensive income. Then we come to fee income and expenses. So if there is any fee income and its expense relating to the financial instrument, this must also be disclosed. Then you have to also disclose analysis of the gain or losses in the statement of comprehensive income from the recognition of financial asset at amortized cost. So if you have derecognized a financial asset that is measured at amortized cost, you have to present analysis of the gain or losses in the statement of comprehensive income. Now we want to look at the nature and extent of risks that must be disclosed. The nature and extent of risk disclosures. Now we have various forms of risks. We have credit risks, liquidity risks, and then we have the market risks. Now when it comes to credit risks, what is required of you to disclose? You have to disclose the credit risk management practices in the organization. You have to disclose information about amount arising from expected credit losses. Information about amount arising from expected credit losses. Then you have to also disclose credit risk exposure. So if you are going to be exposed to any form of credit risk, you look out for or you disclose this. Then you disclose also collateral and other credit enhancements obtained. Collateral and other credit enhancements obtained. You must disclose all this with regards to the credit risk. Now when it comes to the liquidity risk, as an entity shall disclose a maturity analysis for derivative financial analysis liabilities, a maturity analysis for derivative financial liabilities. So it is expected that you disclose this under liquidity risk. Then you have to also disclose a description of how an entity manages the liquidity risk. So if there is a liquidity risk, how does it manage this liquidity risk as an entity? So it must also be disclosed. Then we have the last one being the market risk. Market risk. With the market risk, you have to disclose the currency risks, the interest rate risks, and other price risks. So these are the three items that must also be disclosed in the financial statement when it comes to market risks: currency risks, interest rate risks, other price risks. So basically these are the three extent of risks, or the nature and extent of risks: liquidity risks, credit risks, and market risks, that must, or informations about them must be disclosed in the financial statement. So in summary, we've looked at the disclosure requirement on financial instrument, and the standard that basically looks at this is IFRS 7 financial instrument. So in the whole of unit 2, we are looking at accounting for financial instrument, and we look at the need, why the need to account for financial instrument. We look at the complex nature of financial transaction, the complex or the nature of business practices or transaction. We've also looked at financial IAS 32, talk about financial instrument presentation. There we look at the definitions of financial instrument and its component part. We've looked at what it means by compound instrument, and then we move on to define the various elements of the financial instrument: financial asset, financial liability, and equity instrument. And under IFRS 9, which talk about the financial instrument itself, We look at financial assets, we've looked at financial liability, we've looked at the equity instrument, we look at the initial measurement of a financial instrument, we look at the subsequent measurements of a financial instrument, we've looked at certain examples under each. We look at compound instrument, how we split it, and then the subsequent measurement. And in the last session, we have looked at the disclosure requirement for financial instrument. So this is all about unit 2. Kindly read the model, solve more questions, ask questions if need be for clarification and for understanding. Thank you very much and see you in the next lecture.